There is a wallet on the Bitcoin blockchain that hasn't moved a single inch in 15 years, and inside it,
Roughly 1.1 million Bitcoin.
At today's prices, we're talking about $76 billion. The owner is a person, or maybe a group, known only by the pseudonym Satoshi Nakamoto. Now, most people just assume those coins are sealed away forever, like some digital pyramid that nobody can ever open. But they're wrong. You see, the cryptography locking up Satoshi's wallet was state-of-the-art back in 2009, but by 2028, it might just be the most exposed cryptographic target on planet Earth.
Right now, roughly 1.7 million Bitcoin sit in early addresses carrying the exact same vulnerability. So the Bitcoin community is locked in a massive public debate. Do we freeze those coins forever? Or do we let a future quantum computer just take them? Make no mistake, this is the most consequential governance debate in the entire history of Bitcoin. And yet almost nobody outside of a tiny group of cryptographers really understands what's actually happening. Well, today, we're going to fix that.
Welcome back to The Explainer. Today we're unpacking the Bitcoin story that the mainstream financial press just isn't ready to tell. We're going to cover why Satoshi's specific P2PK addresses are so vulnerable, walk through a proposal called BIP-361 that could freeze millions of coins, and break down exactly what all this means for Bitcoin's price and that fundamental keys mean coins philosophy. Let's get right into it. To truly understand why these coins are uniquely vulnerable, we have to go back to a tiny but incredibly consequential piece of Bitcoin history. Back in the very early days, we're talking 2009-2010, the network used an address format called pay-to-public key, or P2PK for short.
Now, in a P2PK transaction, the public key is written right there, directly into the script that locks the coins. Anyone looking at the blockchain can see exactly what public key controls each output. It isn't hashed, it isn't hidden, it's just sitting there, in plain text, on the public ledger. A few months later, developer Hal Finney and some others pushed Bitcoin to adopt a new format. This one was called Pay-to-Public Key Hash, or P2PKH. With P2PKH, only a cryptographic hash of the public key is recorded on-chain. The actual public key stays totally hidden until the exact moment the owner actually spends from that address. It was a massive security upgrade, because even if someone cracked the underlying cryptography, they'd still need the public key to launch the attack, and you only see that key when the funds actually move. But here's the catch. Satoshi mined a ton of those early coins, and he never updated them. He never moved them, which means roughly 1.1 million Bitcoin attributed to Satoshi are just sitting there in P2PK addresses, their public keys fully exposed on the blockchain, available for anyone to read, today, right now. And that includes a future quantum attacker.
When you tally it up, roughly 1.7 million Bitcoin sit in these early P2PK addresses. That's about 8% of the total Bitcoin supply that will ever exist. And just counting the directly exposed P2PK pile, including Satoshi's, you're looking at an attack surface of roughly $120 billion at current prices. But wait, it gets bigger. Independent estimates suggest that if you count addresses that were reused after spending, the total amount of Bitcoin with exposed public keys could be as high as 6.9 million. That's nearly a third of the total supply. And this attack surface is permanently on-chain. It can't be unrecorded. The public keys are already visible. The only real question is, when does the math arrive to break them?
So let's walk through the mechanics of this attack in concrete terms, because honestly, most coverage of this just hand waves the science away.
Back in 1994, a mathematician named Peter Shor published a groundbreaking algorithm. He proved that, given a powerful enough quantum computer, you could solve the elliptic curve discrete logarithm problem in polynomial time. Translated into plain English, Shor's algorithm can derive a private key directly from a public key. The math runs both ways, as long as you have a quantum machine big enough to run the numbers.
For 3 decades, the size of the computer you'd need was considered absurdly large. We're talking 20 million qubits, numbers that were just way beyond what any actual hardware could ever approach. But then, in March of 2026, Google's Quantum AI Research Group published a paper that completely recalculated the resource requirements. Their new estimate? About 20 times lower than the previous industry consensus. The thresholds shifted dramatically, from 20 million qubits down to roughly 1 million logical qubits. Now, to be clear, that is still beyond what current hardware can do, but it's no longer science fiction. That's a number sitting right there on the planning horizon of every serious quantum laboratory in the world.
Now imagine running this attack on Satoshi's coins. The public key is already sitting on the chain. A quantum machine runs Shor's algorithm against Satoshi's public key, derives the private key, and simply signs a transaction. The network confirms it in the next block. That's it. There's no fraud detection, no account freeze, no insurance claim to file. The Bitcoin is just gone. And even scarier, something called a mempool attack. A quantum attacker could theoretically derive your private key during the 10 minutes your transaction is just waiting to be confirmed. They'd intercept your transaction and replace it with their own before yours ever lands. Google actually estimates that future quantum machines might crack a Bitcoin private key in approximately 9 minutes, which is an uncomfortably tight window.
I should point out that mining itself is safe. The proof of work that secures the blockchain ledger relies on hash functions, specifically SHA-256, not ECDSA, the elliptic curve digital signature algorithm used for wallets. Hash functions do get weakened by quantum algorithms, but only modestly. The security level drops, but it certainly doesn't collapse. So Bitcoin's chain history remains robust. The vulnerability here lies specifically in the cryptography that proves wallet ownership.
Which brings us to a radical proposed solution. In April of 2026, a group of Bitcoin security researchers led by Jameson Lopp posted a draft for a Bitcoin improvement proposal called BIP-361.
The headline of BIP-361 is pretty simple. Freeze the quantum vulnerable coins. Specifically, they want to render unspendable any Bitcoins sitting in P2PK addresses, along with any addresses where the public key has already been revealed through past spending. And yes, that includes Satoshi's coins. The argument in favor is actually straightforward. If those coins are still spendable when a quantum computer finally boots up, the attacker just wakes up to a $76 billion bounty. They steal the coins, dump them on the open market, the price completely collapses, and all trust in Bitcoin's ownership model collapses right along with it. By proactively freezing those vulnerable coins, the network completely removes that bounty before any attacker can claim it. The logic is the coins were going to be lost anyway. Freezing them just decides who loses them, the network in a safely controlled way, instead of some adversary in a chaotic, catastrophic one.
But the argument against the freeze is just as straightforward, and frankly, it carries a lot of philosophical weight. Bitcoin was built on one absolute foundational promise: your keys, your coins. Nobody can freeze your assets. Nobody gets to decide what your wallet is or isn't allowed to do. That absolute property right is exactly what gave Bitcoin its identity from day one. Freezing P2PK addresses shatters that promise. It sets a dangerous precedent that somehow some coins are more equal than others.
Prominent figures like Avalanche CEO Emin Gunsirer have argued in favor of the freeze, but others argue the exact opposite, that Bitcoin's core neutrality, its stubborn refusal to distinguish between wallets based on age, identity, or perceived risk, is the very thing that makes the protocol credible. If you strip away that neutrality, you fundamentally change what Bitcoin is. There's no clean, easy answer here, just very difficult trade-offs.
So, where do we go from here? The community essentially has 3 paths forward, and every single one of them echoes past governance fights.
Option 1 is the freeze. The vulnerable coins are permanently locked via a hard fork, but this requires every node operator to agree, accepting a massive one-time philosophical breach just to protect the network's overall security. Option 2 is migration. Holders are given a grace period to move their funds to new post-quantum secure addresses. But here's the catch: Satoshi's untouched coins would remain exposed. This path preserves the keys or law principle and looks a lot like Ethereum's current roadmap. Then there's option 3, do nothing. Maintain absolute philosophical purity and let the market absorb the impact whenever the quantum theft finally happens. Much like the block size wars of 2015, this governance fight is going to be messy, it's going to be slow, and it's going to be ugly. But the quantum timeline, it doesn't care about our debates.
Now, let's talk about the market consequences, because let's be honest, that's the question most people actually want answered.
In Scenario 1, the freeze passes. Up to 6.9 million Bitcoins suddenly become permanently unspendable. The effective supply of Bitcoins drops dramatically. Basic economics tells us the remaining Bitcoins should rise in value to compensate, which makes this, ironically, the most bullish scenario for current holders. In Scenario 2, migration succeeds. Active holders move their coins to safety, but Satoshi's stash becomes a known, lingering long-term liability. The market would likely price in the probability of a future theft, which acts as a slow, heavy drag on price expectations. And in Scenario 3, we do nothing. The community can't reach a consensus and quantum theft arrives. Even if only a tiny fraction of coins is actually stolen, the narrative damage would be absolutely enormous. Confidence in Bitcoin's security model would take an immediate and severe hit.
And we're actually starting to see the market price some of this in already. Cryptographically focused funds have begun reducing their exposure to chains that don't have a credible post-quantum roadmap. Meanwhile, dedicated quantum-resistant projects that utilize lattice cryptography have seen some really meaningful inflows. Capital is migrating before the hardware even gets here. The smart money is treating this as the single largest unresolved risk factor for Bitcoin's 2030 valuation.
But there's one final detail here that almost nobody mentions, and it's fascinating. Satoshi Nakamoto actually saw this coming.
In a forum post all the way back in 2010, Satoshi wrote about this exact kind of scenario. His precise words were, "If SHA-256 became completely broken, I think we could come to some agreement about an honest blockchain history before the breakdown." Now, Satoshi was talking about a hash function failure there, not elliptic curve failure, but the underlying principle is identical. The creator of Bitcoin himself openly acknowledged that there are extreme circumstances where the network might need to coordinate to protect against a catastrophic cryptographic failure. He didn't consider it a betrayal of the protocol's core principles. He considered it a foreseen possibility. We literally have his words on it. He understood the risk, and he understood the necessary response. The only question left is whether the community he built has the wisdom and the speed to act on his foresight before the hardware catches up.
We're looking at a deeply split community and a quantum timeline that's shrinking faster than decentralized governance can move. So what do you think? Should the network freeze the vulnerable coins to save the system? Or should keys are law remain obsolete? The next explainer covers the post-quantum stablecoin revolution and the decentralized finance infrastructure designed to outlive this exact transition. You definitely won't want to miss it. Thanks for joining me on this explainer. Remember, the future isn't coming. It's already here.